Hi, I'm Paul Diggle, Chief Economist at Aberdeen. Welcome to our April Macro Outlook video. We're filming this on Wednesday, the 8th of April, only hours after receiving news of the 2-week ceasefire between the US and Iran, which came just ahead of President Donald Trump's threatened deadline for large-scale infrastructure strikes on Iran. The terms of the ceasefire are still somewhat unclear, to say the least. Trump has said that an Iranian 10-point plan is a workable basis on which to negotiate. That plan reportedly includes Iran not seeking possession of nuclear weapons, but it also includes Iran establishing some sort of protocol for navigation of the Strait of Hormuz, compensation for reconstruction costs, and the lifting of sanctions. In particular, the Iranian foreign minister has posted that for a period of 2 weeks, safe passage through the Strait of Hormuz will be possible via coordination with Iran's armed forces and with due consideration of technical limitations. Iran may be taking coordination to mean a toll, reportedly $2 million per ship for some recent transits, and technical limitations could mean a controlled throughput, enough to secure the ceasefire but not enough to lose leverage in negotiations. Markets have understandably taken the news as a big risk-on trigger. At the time of filming, Brent crude oil prices were down 50% to below $100 a barrel, the dollar has weakened, and high beta trades such as Korean or Taiwanese equities or gold have rallied substantially. Bond markets have repriced dovishly, with around a 50% chance of a rate cut this year now priced for the US Federal Reserve, and expected European central bank rate hikes pared back from 3 to 2 hikes this year. Throughout this and previous market crises, we have used a scenarios approach in recognition of the uncertainties and as the best way to manage the risk in investment decisions. We've today updated these scenarios to make our TAC oil scenario our base case once again with a 60% probability. This scenario still involves oil prices remaining elevated relative to the pre-conflict level, reflecting logistical backlogs in restarting Hormuz traffic, lasting damage to energy infrastructure, and uncertainties around the stability of the ceasefire. And there will still be some permanent scarring to the global economy, with inflation higher, growth lower, and monetary policy tighter relative to our pre-conflict forecasts. There are big physical bottlenecks still building in refined petroleum products, including jet fuel, in fertilizer feedstocks that come from the Persian Gulf that will push up on food prices, and in helium supplies, essential to silicon wafer production and a variety of other supply chains. These will not go away immediately, even if the ceasefire holds. But in that scenario, there is probably not a fundamental break in the global economic cycle. This is a slight worsening in the global growth-inflation trade-off and a significant shock to Gulf economies, but not a new stagflationary shock or global recession. Nevertheless, today at least, we are putting a 40% probability on the ceasefire breaking down, split between the scenarios we have been calling conflict risk dominates at 20% and the extreme downside stagflation scenario at 20%. The US will not agree to everything in Iran's plan. For example, paying for reconstruction is a non-starter, while sanctions relief would be a significant loss of face for the US. And most importantly for the global economy and markets is the question of the Strait of Hormuz. Iran will want to maintain deterrence from future attacks via control of the strait, while the US is seemingly assuming traffic can normalize by itself. Now, a reasonable base case is probably that some sort of middle ground can be found on these issues, with the strait gradually reopening. Perhaps that involves convoy operations coordinated by other nations. Perhaps the US gets some sort of cut of a new tolling system. The added cost of a $2 million transit fee would be fairly marginal per barrel of oil, in the order of $1 per barrel for a typical VLCC or large tanker. Another risk is that ongoing Israeli action in Lebanon makes a ceasefire highly unstable. And it's still possible President Trump is buying time for more US military assets, including a third aircraft carrier and additional ground troops to arrive in the region ahead of a resumption of offensive operations. So all told, markets have understandably taken news of the ceasefire as a major risk-on event. What's going to matter most in coming days is the extent of the increase in maritime traffic through the Strait of Hormuz. But there are many outstanding questions over whether the ceasefire will stick and the extent of the lasting damage to energy markets and the global economy over the medium term. What we can know for sure, and as we have spoken about in multiple Aberdeen research pieces, is that we are in a regime of structurally elevated geopolitical risk and more supply-side shocks hitting the economy. That means higher and more volatile inflation, less bond equity diversification, more defence spending, and greater emphasis on supply chain security, access to critical resources, and dual-use infrastructure. These trends are reshaping portfolio construction and where to find investment opportunities. Thanks for watching. There's plenty more on the research and insights section of the Aberdeen Investments website, or you can reach out to your Aberdeen representative for a follow-up. Until next time, goodbye and good luck out there.